Hello all. It is almost 11:30 a.m. and we're just a minute away from starting, so we're just letting a few stragglers come in, but we have got a full house today and a lot to cover, so we're super excited. In just another minute or so, we will be jumping right in. All right, without further ado, we're going to get underway. Thank you for joining us. This is the 7th Annual Loan Review Industry Benchmark Survey. We have a great turnout, so we want to thank everybody for being with us. Before we get too far into it, I do want to take a moment and introduce you to me and our co-host, Skip Constantine. I'm Jim Exander. I'm the Senior Vice President of Sales and Marketing for DiCom Software. This is my 2nd annual loan review survey webinar, so near and dear to my heart, something I very much enjoy, and I'm very happy to have you all joining us. Skip has joined us earlier this year, and he's our market specialist. He comes to us with a banking and regulatory background, and his role is really to help align DiCom with the needs of the industry and also be an advocate for the loan review industry. Some of you may have participated in his previous webinar earlier this year that was all about the impact of e-commerce on loan review or loan portfolios. So excited to have Skip joining us as well, and just want to get some housekeeping out of the way. The purpose of the webinar is really to present the key loan review findings and trends that we are able to glean through the survey process. So most of you, since you're invited to this special session, most of you have completed the loan review survey and contributed to our results. So thank you very much. What we do is we take all this raw data and we slice it, we dice it, and we try to find trends and present the information in a way that is beneficial to you. And in a way that is beneficial to you is a way that you can benchmark your organization against others in the industry that are in the approximate same asset range. So we know that we get a lot of feedback from you all in different ways to present the information. We hope that you find the way we presented it this year to be very beneficial. We have muted you on the call, and it's not because we don't want to hear from you. It's really to eliminate background noise. We've got our WebEx session maxed out here with attendees, so we want to be considerate to everybody on the call. And you may submit questions via the WebEx chat panel or via email, and I will follow up. We won't be answering questions during this session, but I will follow up. And I would recommend if you email me directly, it's easier, it's faster, you'll get a quicker response. But if you prefer the WebEx chat panel, by all means, go ahead and use that, and we will we'll respond to you as early as we possibly can. So about the content we're going to be going through, those of you that completed the survey know there's several different, about 5 different segments within the survey, and it's all about, first and foremost, understanding the demographics and segmentation of the respondents. So this is the endeavor to tell you who responded to the survey, how many banks in each particular asset range participated, and give you an idea of how much of the market that represents. Then we'll talk about probably everybody's favorite section, the department staffing section. This is all about junior level staff all the way up to management level staff, experience levels, salary, etc. We get a lot of questions about this content, usually during the survey process after the survey process, before the webinar, after the webinar. So this is definitely an area that people tend to utilize for their budgeting purposes and benchmarking purposes. Then we'll talk about the loan review process, the credit risk management process, and then we'll dive into the last bit of the webinar, which is all about management reporting, guidelines, and structure. So diving right in, let's talk a little bit about the survey, just so you get a flavor for how many responses we have and in which segments those respondents came in. So if we look down here at the bottom right portion of the screen, we've got a little column here that talks about the number of responses. These are the number of banks we have responding and the various corresponding asset range that they represent. Then we have the next column, which is about the industry total of banks. And this is based on FDIC data, which is publicly available. It's a little bit of a pain to slice and dice, but we do that, and we get the number of banks that make up the total market within each one of these segments. And then we give you a percentage of banks responding over here. So if we look at the $5 billion to $10 billion asset range, of the 82 banks in this segment, 27 participated. And what we really have here is, between the $1 billion asset range all the way up, we've got a pretty good response rate. I mean, we have 41 respondents in the $1 to $5 billion asset range, so not a huge percentage, but still a fairly substantial response quantity, and then above 30% for the rest of the assets. So with that said, going forward, I'll be presenting any segmented data from the $1 billion asset range up. We'll certainly use the smaller banks' responses and some of the other content when it's commingled, but when we segment it out, we're going to be just looking at banks over $1 billion in asset size. So moving on, we took a little different spin on the loan portfolio sizes this year, and this is based upon really the first question of the survey. And last year what we presented was an average asset size based upon dollars for each one of the bank asset ranges. And while this is helpful and nice, what we found and what feedback we got from you, the folks that participated in the survey and also utilized this information, was that percentages would be a better benchmark and allow you guys to analyze your data a little more granular and appropriately. So what we find here is each one, C&I loans, CRE loans, and consumer retail loans here in gray, all broken out by percentage of total portfolio. And there's a couple key takeaways here. And the smaller, not smaller banks, but the less huge banks, I should say, from the $1 billion range all the way up to $20 billion, we find that CRE makes up the largest percentage of the total loan portfolio. It's when we get to these largest of asset sizes that we find that C&I makes up a larger percentage of these loan portfolios. So just a little different dynamics of makeup of bank based upon asset size, and this will help you kind of benchmark, are you special, unique, are you similar to the industry, and if you aren't, is there a special strategy that you've got at your bank that might be the reason why you might be a little different than the typical. So moving forward, we'll look at loan review department staffing, everybody's favorite section. And first and foremost, we dive into management personnel, and we break this down by asset size, and then also in blue here, staff members that are performing a management function only, and then in orange here, management personnel that are also performing hands-on review work. And what we find here is that, first and foremost, we've got more of a makeup of management staff performing hands-on review work from the small banks all the way up to really the $50 billion range, where we start getting a full-time staff member that is primarily responsible for just managing staff. We're talking about the $10 to $20 billion range, where we've got about a full-time equivalent here. When we get to the largest of banks, above $50 billion, we're finding that there's a shift to hiring personnel that are associated with management only, where they may have, in these largest of banks, say $60 billion in assets, we may have 3 managers that are really managing staff, maybe different locations, and then we've got a couple kind of loan review management supervisory type positions where they're senior level folks, but they're also doing hands-on review work. So that's just the dynamics and makeup of the various asset ranges we have here. And if we take a look at junior and senior level staff members, we break that down here with a stacked bar graph where we've got average number of junior staff members stacked on with average number of senior staff members. And what we've got here is the various asset ranges, and we've got a couple key distinct takeaways. First and foremost, banks of all sizes are more likely to hire more senior staff members than junior staff members. And that may be by design because loan review function is a very critical function that's not an easy function to just step right into. And it also may have something to do with a lot of what we're hearing in the industry, that finding loan review professionals and new younger blood to join the profession, so to speak, it's not the easiest thing in the world. So that may be also what's driving that difference. But we also find that as the bank size increases, as does the staff in a fairly linear manner. So not a big surprise there, but something that we certainly want to showcase and help you from a benchmarking analysis standpoint. So then we move on to junior staffing levels, and this is a year-over-year analysis from 2016 here in gray, 2017 here in orange, and 2018 here in blue. And what we have here is a line chart, line graph indicating whether or not there's a net increase from 2016 to 2018 or a decrease. And what we find is a little bit of volatility within the junior staff levels across the various bank sizes. And what I would say, whenever we get this type of volatility, you can do your own analysis on this and maybe have your own takeaways, but what I like to say is if you're looking to get kind of your average staff level for benchmarking purposes, smooth this out. Take a 3-year average, and that might be the best approach because there does appear to be a little bit of volatility with the data. But there's a little bit more distinctive trend here when we look at the senior staff levels. We've got a more pronounced stepwise increase where it looks like there's been an investment over time in senior staff levels, with one exception in this $10 to $20 billion range. So we take this information, we've just looked at junior staff levels, now we're looking at senior staff levels, then we take a net staff change over prior year, which is just adding junior and senior staff levels together, which would give you an idea of your total staff size at the different bank sizes. So here where we've got the $5 to $10 billion range, we're at about 5 staff members. That's an approximate estimate, but fairly accurate when we trace this back to some of our clients and some of the others in the industry that we can actually validate this data against. But what we find here is, aside from this slight decrease in the $50 billion range, we've got net increases and then a fairly significant decrease here in the $10 to $20 billion asset range. And we always like to try to figure out what is the root cause here and what's a hypothesis that we can come up with for this, we'll call it an anomaly. And what's interesting is we looked at the number of banks in the $10 to $20 billion asset range that made up the marketplace according to the FDIC data in 2017. We had 36 banks. When we look at this data now, current data in 2018, we've got 49 banks in that segment. That's an increase of 36%, which is considerable. So what we've hypothesized is what may have happened is a number of banks from this smaller asset range have just crossed this threshold into the $10 to $20 billion segment, and in doing so, their staff makeup may not have grown and aligned right in lockstep with their asset growth, and they may look closer to a smaller bank, which would indicate why the staff levels might be down a little bit lower. So just some food for thought and some of the analysis that we did that might be fun for you to mull over with your staff and colleagues within the industry. Then we look at average years of experience by staff level, and we've got some pretty notable key takeaways here. Same as last year, really, but what we find is there's a considerable increase in years of experience based upon the staff level. More years of experience from going from junior to senior staff, and more years of experience going from senior to management staff. Not a huge surprise there, and one trend that we had last year that holds true is senior staff levels and management staff levels tend to have more experience as the bank size increases. So the larger banks are hiring more seasoned people with more years of experience. We don't necessarily see that at the junior staff level, though. So whereas, there's some difference between senior staff and management staff as bank size increases, when we look at junior staff, it's really not very notable there. A junior staff member at a small bank is very similar to a junior staff member at a large bank. And then we look at the big one here, the salary levels, one of the more requested slides that we present here. And we've got, of course, the obvious. Salary levels tend to increase as bank size increase. And that's across all levels, junior staff, senior staff, and management. So you see a positive slope here with the trend line for each one of these. And what that does, that really gives us the ability to run ranges for the various assets or various staff level. And what we get is junior staff tend to range between 60 and 82,000. These are national averages, by the way. They're, we don't have enough data. We don't really collect data on location, so just consider these as national averages. But senior staff members, 89,000 to 120,000, and management level staff, approximately 110 to 146. So these are good for benchmarking. Are you in the range? Are you way off one way or another? But definitely good to compare against the marketplace. And then we look at bonus eligibility, and not a huge shift or not much of a shift from last year. We looked at this, cross-referenced it against the various asset sizes, and we also find that this information is common across all asset sizes, that bank-wide bonus pool is the most popular option for providing bonuses to loan review staff. The good takeaway there for loan review staff members is that you've got an 87% chance of getting a bonus. The ever unpopular 13% none puts you in a distinct minority there, but there may be other compensation methods to offset that. But again, takeaway here, regardless of asset size, bank-wide bonus pool is the most popular. And then we have a really good slide here that's good for benchmarking your organization from a staffing standpoint to determine, are we staffing at approximate levels in line with the industry, or are we offset on the low end or the high end? So what we have here is a couple key takeaways, really two main takeaways that I see, and you may see more from your perspective, but first and foremost, exposure per staff reviewer increases with the size of the bank. That's the trend line here that we've got across the 2018 bar here. And then if we look at year over year across the various asset sizes, with the exception of the small asset ranges, we see exposure per staff reviewer increasing year over year in a fairly predictable stepwise manner. So we find that the larger banks are increasing exposure per staff reviewer year over year. So they're expecting to do more with less. To be quite honest, that's one takeaway to have there. And then we look at whether or not support staff is made available to the loan review department. And we break that down by either whether or not there is no loan review support staff within the various asset sizes. So this is the red bars we have here. And then we have several options whether or not they've got support staff outside the department, approximately one administrative staff member or three. And what we find here is that as the bank size increases, the likelihood of providing support to the loan review department increases. So here where we've got 4 out of 5, over 4 out of 5, again approximately 4 out of 5 that are reporting no support staff, as we get to these larger asset sizes, we find that there is a likelihood to provide approximately one staff member here or more than one staff member as we get to the largest banks. So key takeaways there, if you're at fairly large bank, there's a good likelihood you've got one or two administrative staff members to support the loan review department. And then at this point, I'm going to take a break so you don't have to listen to me talk the whole time, and let Skip take the helm here for a little bit.
Thank you, Jim. Staff training likely increases with the size of the bank. As the bank size increases, so do the size and complexity of the credits. Larger banks make larger loans. Therefore, additional training needs should be anticipated due to an increase in lending complexity. So the takeaway here might be, if you see your loan portfolio growing through organic or merger activity, anticipate possible training needs if there's a significant jump in asset size of the institution. Annual training budget for review staff. This is a pretty brief slide. The takeaway here is the budget's between $500 and $1,000. Maybe you don't send everyone to the training, just send one or two people, and when they return, they can disseminate the information to the rest of the loan review team to maintain efficiency during any type of review that might be going on. Section highlights. Management personnel typically are more likely to perform hands-on review work in all but the largest banks. Salary and experience levels trend up as the bank size increases. Banks of all sizes are more likely to employ a larger percentage of senior staff compared to junior staff. Asset exposure per reviewer increases as the bank size increases. Exposures are trending up over the past 3 years. Banks over $20 billion are likely to have admin support for the loan review department. Okay, Jim?
Excellent. And now we'll talk about the loan review process. And first and foremost, we'll talk about respondents' likelihood to outsource the loan review function. And really two key takeaways here. First and foremost, most banks are not likely, most banks at least above $1 billion in total assets, are not likely to outsource their loan review department. They're more likely to keep it in-house. However, as the bank size increases, the decision or likelihood of outsourcing the loan review function decreases. You see, when we get to these asset sizes above really $10 billion, very, very low likelihood of outsourcing that function. So again, the main takeaway probably as portfolios get more complex, as the loan review process gets more complex, the ability to outsource and the decision to outsource diminishes. And when we look at the next slide, we really identify those banks that are outsourcing the loan review function. What are the primary reasons for doing this? And cost savings is the #1 reason. And just to point out, multiple selections were allowed for this question, so these don't total 100% obviously, but basically half of the respondents that were deciding to outsource the loan review function cited cost savings as a reason for that. And then other significant responses were independence of role, flexibility of implementation, and lack of skilled staff currently in place. So really the top 4 significant reasons there. Then we look at primary objectives of loan review. This is a pretty profound and consistent slide every single year, and we find that the top 2 responses have remained unchanged in 3 years. And just to pause for a moment, these numbers here represent a scale of 1 to 10 or 10 to 1, 10 being the most significant objective. So here we've got risk rating accuracy as the #1 response, as we would expect, and asset quality being a distant second. But what's interesting, risk rating timeliness was almost equally rated against asset quality. And then we've got underwriting and policy compliance rounding out the top 5 responses as the primary objectives. And then we look at the location that loan review is performed. And we broke this down into the various asset sizes, and we found that it really just cluttered the slide, that performing loan review at the primary office was the most common option across any of the asset sizes. And then 1 out of 4 respondents looking at doing a combination of on-site and at the primary office. And then last but not least, we've got 1 out of 20 selecting their their ability to or desire to travel to the site. And then at this point, I will turn it back over to Skip to take it away for a little bit.
Okay, approach is used to set the loan review schedule. Risk-based scheduling is slightly ahead, followed closely by targeted reviews and then calendar reviews. So risk-based is the popular one. A risk-based approach. As mentioned in the previous slide, a risk-based approach is the most popular one. This slide takes a more granular look and breaks down the data by bank asset size. As the size of the bank increases, the likelihood to set the review schedule by risk criteria also increases. And
here, we've got really a question that's near and dear to our hearts this year. And this is really the level well, the review level for the respondents. And the options are relationship, borrower, and note level, or any combination thereof. And any of you that are following DiCom closely know that we've been hard at work on CQS Release 11. That's all about providing risk-based scoping at the relationship level. So this is a question that's near and dear to our hearts because we're investing a lot of time and effort to improve our product and the efficiency at which it operates to perform relationship level reviews. And what we find here is over 70% of the respondents are reviewing at some permutation of the relationship level, with the most popular being a singular approach of reviewing at the relationship level only. And then the types of loans in review. We adjusted this question a little bit this year, and this was based on Skip's feedback. We had him look at look at all the questions, and he found a few of the questions that he thought we could tweak a little bit and improve. And what we found here is that he thought equipment should have been added to the response option list, and we find that that was a good idea because when we look at the survey responses, we find that construction and commercial real estate are the top two, or top number one, tied for number one, types of loans in review, most popular. And then we find equipment is a close second, followed by ABL, agricultural, and then all the way down to dealer finance here. So moving on, we look at sample selection criteria. And this is something that there's no giant surprise here. Whenever we interface with our customers to talk about their scoping process or we're doing demos for those in the industry, we always find that large borrowers the most popular. It's kind of the king of scoping criteria. But then we find that there are a number of other criteria used to round off large borrowers, not the end-all be-all, and we find that new loans, problem watch list loans, a risk-based selection criteria, and then past due status also make up the top 5. So these are really the most significant of all the questions that we ask, with large borrower being king. Then we look at the risk assessment criteria that's evaluated by loan review. And we find that, no big surprise, credit quality is number one. And good credit quality is what returns the most value to shareholders, so we're not really surprised there. But we do find there's some other significant responses that are criteria that are evaluated. And we find that concentrations is critical, prior year loan review results, exception levels, and size of portfolio also factor in. Then we look at estimated coverage of portfolio outstandings. And there's a couple key takeaways here. I know it's a lot to take in. There's a lot of data on this slide, but if you remember, back on slide 18, we were wondering why it looked like loan portfolio sizes were growing faster than staff levels at the larger banks. And what we find is that's probably true because this slide would tell us that the larger banks are covering less of their portfolio. So they are, in fact, doing less with more, which substantiates some of the information we had on that previous slide 18. So again, it's nice when things line up like that and tell us a story. And this is a pretty good rational story here. And then we look at where banks are citing their exceptions. Is it at the note level, at the borrower level, or at both? And we find that resoundingly, both at the note level and the borrower is the most common until we get to the largest of banks, where their perception is really overwhelmingly to cite at the borrower level only. And then we analyze how exceptions impact a review rating. And this is in line with last year's response, but we find that there's a number of criteria that are significant, but far and away, we find that 66% of the respondents, multiple selections are allowed, but 66%, basically 2 out of 3 respondents indicate that they're citing all the exceptions, but the exceptions really impact the review. Only the material exceptions do. And some other perspectives here that are certainly not as popular, but we've got 1 out of 5 that do look at number of borrowers with exceptions to impact a review rating. And then fairly substantial as well, number of material exceptions will impact a review rating, and some less popular options there as well. And then moving to one of my, I don't know if it's my favorite or my least favorite slide, factors that would influence me in both directions, but this is really whether or not respondents are utilizing a loan review system, either from a vendor-supplied system or an in-house system, or if they're utilizing manual tools such as Excel and Word for their loan review process. And what we find is about half of the total market are utilizing manual processes. So there's still a significant amount of market space that's dedicated to utilizing Excel and Word. We find that almost a third of the market is utilizing a vendor-supplied loan review system. Good for you all. It's a fantastic decision from my perspective at least. And then we've got 17%, really a small percentage of the market that's really utilizing an in-house system. So when we look at this broken down across the various asset sizes, we really find that the likelihood to utilize manual processes diminish as the bank size increases. And then we find kind of the sweet spot for buying a vendor-supplied system here at the $20 to $50 billion range, and then the sweet spot for organizations to invest in their own system being the largest of banks at 63%. So we do find that those banks with significant resources are really the only ones that are willing to even try to tackle that type of system. So then some of the highlights from the section. Smaller banks are more likely to outsource the loan review function than larger banks. Cost savings is the primary motivator. 70% of responding banks are reviewing at the relationship level. Portfolio coverage drops as bank size increases. About 50% of the market is still utilizing manual processes for loan review. Most banks are more likely to buy a loan review solution than to build one. And at this point, I'm going to turn it back over to Skip, and he's going to take it over for a little bit.
Credit risk management process. Frequency of review of the ALLL by loan review. It's not very frequent that loan review will review the ALLL as shown here on the slide. We mostly know that the findings of loan review impact the ALLL, but often that responsibility probably falls to the CFO or some other type of risk officer. Other responsibilities of loan review. Primary additional responsibility is acquisition due diligence. And given the high level of M&A that I've been reading about lately, this is probably keeping loan review pretty busy. The secondary responsibility is preparing and managing for regulatory exams. This slide is pretty quick. It's one-dimensional versus two-dimensional risk ratings. As the banks increase in asset size, then the shift begins towards two-dimensional risk ratings. Larger banks think 2D. So who has the final say in loan grading? I used to be a loan review specialist, and the loan review manager overwhelmingly has the final say in loan review grading, so that makes me happy. And then it's followed up by the chief credit officer and actually the loan review officer. And this is consistent with last year's data. Okay, imaging of credit files. This slide is from last year's survey. Last year we concluded nearly all banks, regardless of size, are imaging credit files. This is the rule rather than the exception. So this is no longer a great benchmark, so we thought to ask this question a different way. This is a new perspective that analyzes the completeness of the overall usefulness of that image system. 59% of the users said less than 5% of the documents are missing. This is good, as I've heard chatter that the FRB and the FDIC are looking to do more off-site exams, so they'll be reliant on strong imaging systems. Collateral files tell the same story. This is the slide from last year, and imaging of the collateral files. Basically, collateral files are more accurately imaged than the regular files, and what we think this is attributable to is that collateral files may be smaller. There's less paperwork in a collateral file than a loan or borrower file. Section highlights. Most loan review departments are also responsible for acquisition due diligence. 1D risk ratings are still the norm for banks under $20 billion. Most banks are imaging collateral and credit files and have less than 5% of the documents missing. The loan review manager usually has the final say in loan grading. And back to Jim.
All right, and we're going to wrap this up here in the final section, talk about management reporting, guidelines, and structure. So we retooled this slide a little bit from last year, and I hope it presents a little better. In my opinion, last year's slide might have been a little confusing, but over here in the left-hand quadrant, we have the most common reporting lines for loan review. And then we give survey respondents the ability to say whether or not they have a direct or indirect reporting relationship. And here we find, in order of most significant, Board of Directors, Committee Other Than Audit is the most popular reporting line from a direct perspective and an overall combined reporting perspective. When we look at the Chief Risk Officer, we find a little less likelihood to be a direct report. However, fairly significant, almost 1 out of 4 respondents have an indirect reporting line to the CRO. Then we look at the Board of Directors, Audit Committee, and Director of Internal Audit. Those fairly significant, then taper off real quickly, Chief Credit Officer, CEO, and other being fairly insignificant response rates. Then, not to be confused with a reporting relationship, but the process of providing a report to various functions within the organization is where we're headed on this slide. And we're looking at the frequency and the depth of these reporting. And when we look at reporting to the Board of Directors, we find that overwhelmingly, across all the various asset sizes, summary reports on a quarterly basis are the most common. So this was, again, we didn't present this in a sliced and diced asset-based perspective just because it wasn't a very telling way to present it. It's overwhelmingly summary reports on a quarterly basis. Then we look at the Audit Committee, and we find, again, quarterly summary reports are the most common, slightly less significant, but still 69% of the respondents indicating that that's the depth and frequency of reports. It's when we get to the line of business management, that's where we get a little bit of a different story here. What we find is that maybe the frequency's not super consistent across survey respondents, but we do find detailed, providing much more information to the lines of business is more common here at this perspective. We just find that either monthly or quarterly is going to be a little bit of a toss-up. Then when we analyze what type of assessments are occurring for loan review, we find really two major perspectives, which regulatory assessment being number one, no big surprise there. And then we find that in the last 2 years, quite a few, almost 2 out of 3, doing their own internal audit. And then almost half the respondents also selecting the option to utilize an outside third party. And then bringing up the rear with only 1 out of 10 really responding, performing in their own self-assessment of loan review. Then we take a look at the acceptable level of criticized loans, and we find that really a range is most common here, and we're finding 1 to 5% makes up 60% of the total responses. So if you're somewhere in that mix, you're probably in good company. However, surprisingly, that a fairly significant amount indicated that there's no criteria to analyze that. Then we look, it's no surprise that it's a little tighter percentage here, but when we look at acceptable level of classified loans as percentage of total portfolio, we find that 1 to 3% is the most popular response, and that's making up almost half of the respondents. So if you're in that 1 to 3 range, you're in quite good company. So then to underscore the highlights here, the most common reporting lines for loan review are the Board of Directors and followed by the Chief Risk Officer. Quarterly summary reports are most common to the Board of Directors and the Audit Committee. We find that when reporting to the line of business, detail reports are most common, but at a monthly or quarterly basis is pretty much a toss-up. Acceptable level of criticized loans is between 1 and 5%, and an acceptable level of classified loans is 1 to 3%. So that takes us through the balance of the information from our webinar here. But I do want to make sure that you know that it doesn't necessarily end here. We will distribute the full deck, slide deck. We've hit a lot of slides. Obviously, there's a lot of analysis that did not make it off the cutting room floor here for the webinar, but we will distribute that by the end of July. And the reason for the delay there is we have 2 more webinars that we'll be scheduling later next month to round out the opportunity for those in the industry that are not customers and did not complete the survey. And we'll also be following up and distributing white papers in early Q4. And what are the white papers? They're really a summary documents of what you saw here, but they're broken down. Each asset range will have its own white paper and its own file. And then, of course, please do contact myself or Skip at any time. If you've got a question about a slide, if you've got a type of analysis that you think we should have done that we didn't do, whatever your feedback may be, we're here to help, and we hope that this information provides value to you and your organization. So we really thank you for participating. It's been our pleasure, and we hope to hear from you following this webinar. So without further ado, thank you so much, and have a great day and a great rest of your week.